Okay, so all right, in our last video, we talked about what you need to spot when you open your chart. First thing, you need to go through your 1 hour, 30 minutes, 4 hour time frame, and all you're looking for is either an M pattern or a W pattern, right? Now, after you spotted this thing, what else do you need to know? You need to understand before you now proceed to knowing what else you need to find. Like I told you, whenever you see an M is telling us that we should be expecting what a sell on a lower time frame, and whenever we also see a W, we're expecting what a buy, right? Now, what are we looking forward to? Now, first, you need to know that what our buy and sell will occur on the last leg of the M. Let's say this is the M now. We're expecting the market to come back again to to any institutional reference point found on the last leg of the M. Any institutional reference point found on what the second leg of the M. Now, what are the institutional reference points? Let me write them out here. Number one is, let's say, order block. Number two, we have fair value gap. Number three, breaker block. This is another. Number four, mitigation block. Mitigation block. Is there any other one we can add? Okay, let's make deal with this one. This four is enough. It's more than enough. Even the first one and two is more than enough. But let's just stick to this four. I'll tell the difference between these four. So this is all we are looking out for. Okay. Let me increase. Good. Order block. I don't know if I spelled that order block very well. Fair value gap, breaker block, and mitigation block. Remember what I say, any one of these things found on the last leg of the M is enough. I repeat, any one of these institutional reference points found on the last leg of the M or the last leg of the W is enough. That is all we are looking for. Okay. Now, how do we do this? Now, let's say we are expecting, okay, on this M now, once this first M happens, we want to look for, let's say, an order block somewhere here. If there's an order block, we highlight it. Okay, and then we expect price to do what? We expect price to come back to this order block, and then we sell from here, and then market will drop. That is exactly what is going to happen. That is what we're expecting to happen. But you cannot just mark out your institutional reference point and price comes down to it and you just sell. No. Before you sell here, you need to go back again to the lower time frame, which I'm going to explain once you approach there. Now, this is one thing we are looking for, okay? Now, another thing is that these institutional reference points now can either be an order block, a fair value gap, a mitigation block, fair value gap, or so now let me explain something. When you have a type 1M, okay, and the last okay, let me start with explaining what an order block is. Let's start with an order block because this is what is going to, I'll come to fair value gap last. Okay, an order block, okay, let me say order block, we have bullish order block and bearish order block. In an M, we are looking for what? A bearish order block. A bearish order block is the last bullish candle before a downward movement. Okay, now what am I trying to say? Look at this move that went down. Before this move dropped down, what was the last these red candles now? These are bearish candle, right? The last bullish candle is what? This green one. So this green one is the what? Order block. It's called a bearish order block. Because that's the last green candle or like the last bullish candle before a downward movement. Now, if it is one, fine, but sometimes it can be many. Take for example, for an example of here. This one here now is a what? Is a what? An order block. Okay. This one is called bearish order block. Okay. Now let me give you another example again of beautiful. Look at this one. This one is what to call consecutive order block. Consecutive order block. When the last up close candle is not just one, it is more than one combined together, then it forms also called what? A consecutive order block. So if you see here now, before this downward movement, how many up close candles do you see? 1, 2, 1, 2. So you can pack all of them together and you can call it an order block. But what kind of order block is this? It's called a consecutive order block. Can you see it? Price actually came back to it and reacted. So they sent price lower. Consecutive order block. Right? So know the difference now. The two types of order block. The normal order, if it's a bearish order block, the one that is just one candle, if it's just one candle, highlight it. But if you see more than 1, 2, 3, as many as that are together, pack all of them and highlight them. They form what's called a consecutive order block. So this one is for bearish order block. Now, a bullish order block is the last bearish candle before an upward movement. So as this market starts to go up now, you can see that what was the last bearish candle, which is this one. This is what? A bullish order block. A bullish order block. I've explained order blocks before, but let me just recap it. Now, you also have consecutive bullish order block. The same thing here. All you just have to look for is look for consecutive multiple down red candles before the green candles, which is somewhere. Okay. Let me search for it. Beautiful. Look at this. We have, before this market went up, started running up, we have 1, 2, 3. These are consecutive order blocks. Okay. You can highlight all of them. You can highlight all of them together. Okay. So price went up, came down to it again, went up, came down to it. This is also another one, other block inside another block. This is also a strategy for that, but you can see this 1, 2, 3, 4. These are consecutive order blocks. Okay, so you can also highlight them. And you can see how market also reacted to it. Market went up, dropped down inside it, and then went up again. So that is the two other blocks you need to know. Then when you see an M, when you see a type 1 M, the last bearish candle, okay, before this upward movement, that candle now becomes what we call a mitigation block. Let's say something like this now. Do you see it? If it is type 1, it is what? Mitigation block. But if it is type 2, it is called what? Sorry. I've misled you. If it is type 1, it is called a breaker block, because breaker block takes out a high, is an M pattern that takes out a previous high and breaks lower. So that last order blocks that took price up to take out this high, that candle is what we call a breaker block. But if a thing fails to take out this high, if it went up here and then it broke without taking out this high, it just went up and break down, it is called a mitigation block. Some people also call it a failure swing. Why is it called a failure swing? Because this swing high failed to take out this high. So because of that, it is now called what? A failure swing. So this becomes a what? A mitigation block. Because it has to be the last bearish candles. There's supposed to be like an order block, right? Like, hey, that went up before breaking down. So that last bearish candle becomes a mitigation block. Same thing here. This one now is a what? This one is a breaker block. Breaker block. Now the same thing principle applies to what? This one. When you see the type 1W, the type 1W, the last bullish candle before it starts to drop is what? It gives us what? A breaker block. BRE. Gives us a breaker block. And this one, the type 2, which is the last, yes, last bullish candle that could not take out this low, which is also a failure swing because it failed out to take out this low and then broke. This one now becomes a what? This one becomes a mitigation block. Mitigation block. So what is our expectation now? What are we expecting? We're expecting price to go from here, come down to our breaker block and go up. That is two things that will happen. This, but if it doesn't come down to, why is this thing doing this? If it doesn't come down to a breaker block, maybe there's a fair value gap here or there's an order block here, price will either come down to either the, let me say we have a fair value gap here, or we have an order block. Let me call this one order block. We're about to round up. Let me give it color. And let me give this one a color. Maybe I want to vary it. So we're expecting that in the WDR of this one, price will either come down to the breaker block and then rally up. If it doesn't come down to the breaker block, it's going to come down to a fair value gap. If it doesn't come down to a fair value gap, then it will come down to the other block and then rally up. That is just the strategy, okay? Now, how do we know which one will the market use? Is it going to use this one, or this one? I know that will be the next thing that will be on your mind. How do we know which one is the market going to use? Sorry. To drive price up. This is FVG, fair value gap. Okay? I think I'll explain fair value gap in the next video. So the same thing too. I'm also expecting price in the M. Yes, if this is a mitigation block, then we'll have stop. Then we might have like another block here. Good. And then let's say we have a fair value gap here. Fair value gap, I use yellow. FEG. So, and let's say here is the what? Other block. So what is the market going to do in either of the M? We want to see it come down to mitigation block and drop, or it goes to the fair value gap and drop. If it doesn't use the fair value gap, then it's going to use the other block and drop. That's why you need to know either of these three most important institutional reference point, because that's what's going to frame your entries. It is either here, or here is where you're going to find yourself. So in the next video, I'll be teaching you what you have to do to know where or how to know which one will the market use. Is it going to use the mitigation block, or is it going to use the fair value gap, or is it going to use the other block? Thank you for watching.